Hey guys, welcome back to the Max Spence Business Podcast. Today I have a very special guest. His name's Sarry Ibrahim. He's actually the founder and he's the CEO of Financial Asset Protection. Before we actually jump into this podcast though, if you guys really enjoy what, the people that I have on and I'm interviewing and the content I'm putting out, please subscribe to the YouTube channel and also the podcast. Leave a review. If you can go over to Apple Podcasts and actually like and leave a review as well, that helps out a lot with the podcast. It's great having you on the show, Sarry.
Hey, Max, thanks for having me on. I appreciate it.
Awesome. So why don't we jump right into this? So why don't we start with an intro, about who you were, where did you sort of grow up, and what got you sort of into the financial industry and starting your own company?
Yeah, definitely. So I'm currently a financial planner. I'm from Chicago, Illinois. I started off pretty much working at Allstate Insurance as a business consultant and using like risk mitigation strategies for business owners and like commercial policies. And then I was in grad school at the same time. And then I kind of merged from that. I got into Medicare. So I was helping people who were like 64 years old, who had an employer plan, and then who were merging off their employer plan into their own individually owned Medicare plan. So that was my job for a couple of years. I was like a Medicare representative, Medicare broker, and I worked with companies like Blue Cross, Humana, Cigna, HealthSpring. And then I did that for a couple of years. And then one of my clients asked me if I could help him with life insurance. And he said something about like it has cash value. And I wasn't really sure what he was referring to, what he was talking about. We had a good relationship. And I told him I would do like more research for him. So one of the ways I like to learn is I like to read books. And I went to Amazon and I searched for books about life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about the bank on yourself concept. And what that means is it is the utilization of cash value whole life insurance, mainly for business purposes and for like real estate investing or pretty much for whatever you want, for you to pretty much build wealth and you be able to use it at the same time. So that's pretty much what our firm specializes in. We are a bank on yourself authorized professional group. And we pretty much specialize only on the bank on yourself concept. It's also known as the infinite banking concept. And that's pretty much where we're at and how we connected.
Okay. Awesome. Yeah, that's pretty cool because I've actually never heard of this term, and I'm not too sure if, probably some of my viewers might actually know about it because my viewership is sort of split between Canadian and the US. I'm currently in Canada right now, and I've never come across this, so it might be under a different term, or it might not actually be an opportunity here in Canada. Would you happen to know if the bank on yourself is actually in Canada as well, or do you know anything about that at all?
Yes, yeah, definitely. So the organization I'm a part of, the Bank on Yourself organization, they do have Canadian representatives. So yeah, definitely in all the provinces. So for sure, yeah, it is in Canada. It does work. It's the Bank on Yourself concept. The insurance companies we work with also have a presence in Canada and in the US. So it is, yeah, to answer your question, is applicable in Canada.
Okay, awesome. Well, why don't we jump right into this? Because to be honest, I know nothing about this, so I'm interested to hear what you have to say about it, and sort of like how can this actually help people in the early 20s or somebody else who's maybe a little bit later on in their life. So why don't we just start with like a basic rundown of what actually is like a bank on yourself or an infinite is it an infinite insurance or something?
Infinite banking.
Infinite banking. Okay, awesome.
Yeah, definitely. So pretty much it is using whole life insurance. And for those of you who are not familiar with whole life insurance, it has two aspects. One aspect is the life insurance part, and the other is the cash value. The cash value is like a savings account almost within a whole life policy. So what that means is you own one of these policies, you're allocating money towards it. A portion of every dollar that goes into the policy, a portion of that goes towards the cash value, and then a portion goes towards the actual whole life insurance part. But the purpose of the infinite banking concept or the bank on yourself concept is to be able to grow the cash value as much as possible, and then to actually be able to use that cash value for whatever you want. So as you're building up this like savings plan, it also earns interest and dividends from an insurance company. We only work with mutual insurance companies as opposed to stock-owned insurance companies. So the difference between that, Max, is a stock-owned insurance company, they give their dividends and profits to the shareholders, whereas mutual insurance companies give their dividends and profits back to the policy owners. So when you own a policy with a mutual insurance company, you get dividends from them. And the insurance company, it's a for-profit organization. So what they're doing is they're taking those premium dollars and they're investing them. About 60 to 80% is in the bond market, and then 20 to 40% is in private loans and real estate investing. So they're earning profits on that. They give those back to the policy owners. So that's one way your cash value grows every single year. And the other way is through compound interest. So our dividends aren't guaranteed, but we only work with insurance companies who have been paying dividends for over 160 years. The interest is guaranteed. So now what real estate investors could do, and business owners and pretty much anybody, even full-time employees, what they could do is they could own these policies, allocate funds to them every month or every year, build up the cash value. And then over time, what's going to happen is there's going to be a break-even point where the policy is pretty much paid for itself plus more. So the policy is going to actually give you a return on your money, a multiple of your money over time. It is a long-term investment or long-term play. It's not something like, speculative where you can make, you could flip your money in a year. It's not like that at all. It's safe, predictable growth over a long period of time.
Oh, okay. Okay. Awesome. Yeah. So the first thing that I found really interesting was so pretty much you're getting dividends and you'll be getting like compounded sort of interest. What are the sort of average interest rates that you'll be making on your money within these policies?
Yeah, definitely. Good question. So with the two sources that you have of growth, the compound interest and the dividends, it comes out to every year about 4 to 5%. But it's really important to know with the infinite banking concept, it's not an either or concept. It's not like either I put my money in, infinite banking and I earn 4% on it, or I put it in real estate or in my business, I earn 10% on it. It's a both and concept where you could fund the whole life policy, grow the cash value, and then borrow from the cash value to be able to fund for the riskier investments if you want. So I'll give you an example. Let's say you have $100,000 in cash value in a whole life policy, and then you come across a business opportunity and it requires you to invest $50,000 in that opportunity. You could go to your policy, borrow from the insurance company $50,000 from them, and then you're leveraging your $100,000 in cash value. Now it's going to be like a personal loan that you're borrowing between you and the insurance company, but you can control the payback period. Now, let's say after like 5 years, you paid back that loan. You're going to pay that loan at 5% simple interest to the insurance company, but your $100,000 cash value was never touched. As a matter of fact, it kept growing and earning compound interest on $100,000. So eventually your cash value outpaced the growth of the loan that you took out. So you're going to end up making money in the policy and arbitrage within the policy. And then you're also going to make money in your investment. Hopefully you do in your $50,000 investment. So your money just did two things for you at the same time. And this is exactly what banks do, like large banks and corporations. They have whole life insurance with like billions of dollars. They're earning compound interest in there. And then they borrow from those policies against them. And then they loan that money out via, their payroll, their expansion. They loan out, if it's a bank, they're going to loan out that money via credit cards, mortgages, lines of credit. They earn interest on those, and they earn interest within the policies. So pretty much their money is doing two things for them at the same time. And that's my favorite thing about the infinite banking concept, is that your money could do two things for you at the same time.
Oh, okay. Okay. Awesome. And when did this actually sort of come out and started to, cause like, I've never really heard about this and it sounds pretty interesting. So like, when did this sort of start becoming like a thing? Was this like in the, 1980s, or has it been around for a long time?
Yeah. So the insurance companies, the mutual insurance companies we work with, they've been around for over 160 years. And for a long time, for over 160 years, people have been using like more so the cash value of a whole life policy just for like long-term savings. And the people who actually made it through like the Great Depression and all the wars we've been through and like the downturns to the economy are people who had their money in whole life insurance. But the infinite banking concept and the more of the modern twist to it, to be able to put money in and out frequently and save and become your own source of financing, this has been around for like maybe like less than 20 years. So it's a fairly modern term. It's a newer concept to use, but overall whole life insurance has been around for over 160 years. And there's a difference, Max, between like what we're talking about here and just all whole life insurance in general. So it has to be structured properly. And this doesn't work with all whole life insurance companies. So pretty much, again, as mentioned, it has to be a mutual insurance company. And then number two, it has to be a non-direct recognition loan company as opposed to direct recognition. And what that means is, back to that example we mentioned about having $100,000 in cash value and then borrowing $50,000. If it's a direct recognition loan company, what's going to happen is when you borrow that $50,000, the insurance company is going to say, hey, because you have an outstanding loan right now, we're going to reduce the dividends and interest that we pay you because you have an outstanding loan. Whereas with the companies we work with are non-direct recognition, meaning they're not going to recognize that outstanding loan, and you keep earning dividends and interest on your entire $100,000 as if you've never touched it. So it has to be non-direct recognition. And then the third part to it is that the policy has to be properly structured. So remember how I said every dollar that goes into the policy, a portion goes towards the cash value, and then a portion goes towards the actual life insurance part. A long time ago, old-fashioned policies, every dollar that you put into the policy, 100% of it goes just towards the life insurance part, towards the base life insurance. And then when you do that, you have very, very little cash value, and the growth of that cash value grows very small. And that's how policies have always been, except for about 20 years ago when the infinite banking concept came out, and it revolutionized the way whole life insurance works. And it's something called a paid up additions rider. It's a rider in the policy that turbocharges the cash value of the policy. It's called the paid up additions rider. That rider is what turbocharges the cash value. It's what grows it over time. It's what creates the flexibility of like banking within your policy. And then, so pretty much you'd have to structure the policy with like a 50-50 split, where like half of every dollar that goes into the policy goes towards the life insurance and the other half goes towards the paid up additions rider. Now, that's how you really like make this whole thing work. And that's fairly a modern term or a modern use of whole life insurance. So again, it has to be a mutual insurance company. It has to be non-direct recognition, and there has to be the paid up additions rider for this to all work.
Okay, awesome. Yeah, that sounds pretty interesting. Okay, so there's like, before you jump into this, you have to do some research, and you want to make sure that you have it structured properly. And then so pretty much what I've learned from you so far is just like, you have 50% goes against the, the life insurance, and then the other 50% goes against that cash value. And that pretty much that cash value is, what is that? Is that what you're getting paid on, the dividends and compound interest?
Yeah, exactly. So in the first year, when you're putting money into the policy, let's say, for example, you put $10,000 a year in. When you put that first year's premium in, there is, because it's a for-profit organization, there are going to be fees associated with whole life insurance in the first couple of years. So in the first year, you may see like you're going to put $10,000 in, and then you might see your cash value be like $5,000. And the second year, you put $10,000 in, and then your cash value might grow by like $6,000. So you have a total of $11,000 in cash value. The third year, you put another 10,000 in, and then now your policy may grow by like, 8 or 9,000. And then the fourth and fifth year, and it keeps growing. That's where you start seeing exponential growth. That's where the policy will start to pay for itself. So in other words, there is a dip when you first start the policy in terms of every dollar that you actually put into the policy versus what you have in cash value. So it's not like you can put $10,000 in and then borrow $50,000. It won't work that way. There's a capitalization period apart, excuse me, where you have to fund the policy, grow the policy, and then you could actually start borrowing from the policy.
Oh, okay, awesome. So to dive a little bit deeper on that, is there any other fees that are associated with this? Like, once you have that cash value and you're earning those dividends and the compound interest, is the company taking like a management fee, or are they taking like what percentage fee are they sort of taking?
Yeah, awesome question. Good question. So with whole life insurance structured this way, the highest fees are in the first 2 years. That's when the fees are the highest. And then after that, they start to go down the fees. So the fees, the cost of managing the policy starts to decrease over time. And eventually the policy will pay for itself. You earn more dividends and interest than you actually put into the policy. And then as far as the way we get paid, this is the cool part, is that we only get paid commission from the insurance companies that we work with, and they pay us based only on the first year's commission. So what that means is that if you have a whole life policy with us, we're not going to charge like a recurring 1% fee every single year just for managing those funds. You only pay the commission. You don't actually pay the commission. You only pay the premium the first year, and then from the premium dollars, we get a cut out of that for connecting you with the insurance company. And then again, all our consultations are free consultations. We don't charge any fees for our service. We get paid directly from the insurance companies, and then we don't charge any recurring like 1 or 2% fees every single year for managing your money.
Oh, okay. So let's say on the insurance side, are they charging fees at all? So let's say if you're getting like a 4% back, 4% return on your money, and how much is the insurance company going to be charging for fees? Is it like 0.5%? Is it 1%? Is it 1.52%? Or do you happen to know that from the insurance side, or is it different for each sort of company?
So pretty much in general, the way it works is the fees are the highest in the first couple of years. So like, for example, when you buy the policy and you put in $10,000, and then, year one, you've spent 10,000, but you have $5,000 in cash value. And year one, technically the fees for managing that policy were $5,000 because there's the life insurance part. But then it's a long-term play. So you're going to put in every year $10,000, and then, or it doesn't have to be 10,000. It's just an example, but pretty much the fees are the highest in the first couple of years. But then after that, the fees to manage a policy decline, and there really isn't like a percentage, like they take, X amount out of your money. But pretty much once you receive that dividends and those interest into your cash value, the fees have already been, calculated before they give you. So it's not like they'll pay you the dividends and interest minus their fee. It works the opposite of that. So as the policy is growing, you're going to earn dividends and interest within your money. And again, they're going to subtract the fees from that, but the fees decrease over time. And I think that's like the beauty of this, is that it's, as opposed to other investments, how they get more expensive as you have them longer. And it's not meant to bash, like I'm not trying to bash like mutual funds or investing in the stock market. I'm just saying that those fees tend to climb as those policies increase. Whereas with infinite banking and bank on yourself, the fees decrease over time.
Oh, okay, awesome. So for the premium right now, what is that? So like first year, like that seems like, let's say, like I know we're talking hypothetically here, but like like if you put in 10,000 and 5,000 goes to the premium. So what happens if you put in 250,000? Is that going to mean that like you're going to be at one? Are you going to be at like like are they going to take half of that, or are they is it like how does that sort of work?
Yeah. So there's many different ways to structure these policies. So it could be funded monthly, annually, or a single premium policy, which is like just a one-time transaction, a one-time payment. So pretty much if you were putting in like $250,000 every single year, let's say for 10 years, you would probably get more cash value. It would probably be closer to like 2/3 of your money showing up in the first year, and then it would compound from there. And then there's also, like, for example, I worked on a policy with a real estate investor. He sold one of his properties for $400,000 in cash. And then he bought a single premium whole life policy, which is just a one-time single premium policy. He has no more further contributions remaining. He doesn't need to pay into the policy anymore. So he purchased it for $400,000. And then as soon as he did that, he had cash value of $375,000 in cash value. And then he had the life insurance amount of $580,000. And the cool thing about this, Max, is that both the cash value and the life insurance grow every single year, 4 to 5% every single year, regardless of market conditions. He doesn't have to like worry about the markets crashing. It grows guaranteed 4 to 5% every year, the cash value and the death benefit. And he also has access to the cash value up to 90%. So the point is, there's a lot of different like ways to maneuver around this. You could do the single premium, you could do monthly, you could do annually. And then it's not always going to be like half your money is going to go into fees in the first year, but it's a lot of different ways to structure it. You could see, 2/3 of your money showing up. You could see, less than that, more of that. It all depends a lot on which company it is, which product within that company, and the funding amounts. And it's really hard for us to kind of judge and guess which product would be the best for a client, which company. So that's why we do a financial analysis. We do like a 60 to 90 minute virtual financial analysis where we kind of get a good idea, a good picture of where the client's at, where they want to go financially, what their objectives are. And then we build a policy or a product based off of their analysis.
Okay, awesome. And so with your company right now, I know you mentioned at the beginning. So do you guys only specifically do the bank on yourself, sort of that's sort of those policies, or do you guys do anything else within the company?
Yeah, so mostly we specialize in just structuring these policies, mainly for the cash growth. We help business owners, real estate investors, full-time employees. If it comes to like other types of investments, we have like affiliate partners that we like outsource that business to. Like, for example, if you only want to invest in the stock market, we could kind of partner up with our affiliate partners where we'll do the infinite banking part, we'll do the whole life part, and then the other company will do the stock part. Or if you wanted to do mutual funds, we could do that. We can kind of work in connection with other firms that we're affiliated with. But we don't necessarily like, it's not either you put your money in whole life insurance or you put it in the stock market. We can kind of integrate it with other solutions, but we specialize mostly in the whole life area and the infinite banking concept.
Okay, awesome. And like you were saying previously, pretty much what you can do is you're able to take that, let's say if you have 100,000 or 50,000, you'd be able to take like 25 or 20,000 out of that, and you can invest that into something else, right? And still have that same amount. Okay. Okay. Awesome. So I guess like with this, you could use this. So let's say for bigger commercial properties, I know that you could go to a bank and get like for commercial let's say for multifamily properties, you can go to a bank and get a commercial loan, and that could be around maybe 2 to 3% depending on how it is. Do with these bank on yourselves loans, the money that you have in there. Is that sort of like, would you be able to like contribute that to like commercial real estate at all? Because I know when banks are underwriting for commercial real estate, they're not really looking at yourself. Well, they look at yourself for your experience and what you've done previously and your track record,
Mhm.
but they look more on the asset class that you're trying to buy or purchase. And that's how they underwrite the deal for, let's say, commercial, let's say a 30-unit building or something like that.
Mhm.
Would that sort of happen with the policies, or is it sort of just it's all personal, sort of like personal lines of credit that they're pretty much offering you, or personal loans?
Yeah. So if I'm understanding the question correctly, is it like, are you asking like what could you do with that cash value in the policy?
Yeah,
Like
I was
what could you
wondering.
borrow them?
Yeah, so I was wondering, what are they sort of? Because I know personal loans are probably going to be a little bit more like have higher fees than, let's get a commercial loan or something like that for a multifamily property, or a commercial class
Mhm.
piece of asset, like real estate or something. So I was wondering, if like, would they be able to do sort of both types, like if if that makes sense?
Oh yeah, yeah. Okay, I got you. Yeah, yeah. So you can absolutely integrate this loan with other loans. Like for example, you could finance a down payment on a commercial property for sure, which a lot of our clients do. You can, like for example, if you were to purchase the property and it was $1 million and the bank required 20% down, so $200,000 down, and let's say you had $200,000 in your cash value of your whole life policy. You could borrow from that, use it as your down payment, and the bank will actually, and I've talked to lenders about this, they will accept the down payment or other parts of the funding if it comes from life insurance. Even though you borrowed that from the insurance company, the way that banks view that is not borrowed money. They use it as your own money, as if you took it out of your savings account. So on paper, your cash value can be a measurement of your net worth. It could be proof of a source of income. It could be proof of your actual funds, and it could be in connection with other loans that you do. And we do recommend that, as mentioned, frequently it's not like either or. We do recommend you connect this with your loans. If it's not like either I use my money only in the whole life policy, or I go to a loan or a bank for third party financing. I could use both, and I think that, and I hope that answers your question, Max.
Yeah, no, yeah, that's yeah, that's spot on with that. Yeah, so that actually sounds pretty interesting, because like if, let's say, if like, what are the average fees that they're charging for these personal loans? Is it 5%, 4%?
Yeah, yeah. So it's 5% simple interest. And then pretty much like, for example, if you borrowed for 5 years, that would come out to like 2% APR. So pretty much these loans can be favorable. It's 5% simple interest. And then as mentioned, you're earning 4 to 5% compound interest on your money. That's what explains, like when you borrow from the insurance company, it explains why your cash value outpaces what the loan payments are. So you end up having, like, for example, you'll borrow, 50,000, pay back $2,000 in interest, and then your policy would have earned like 65,000, for example, over that course of financing that property. So you would have like a $13,000 arbitrage in the policy, plus the profit, plus the appreciation or the profit on that property. So it's kind of like doing two things for you at the same time. And then let's say that, for example, you borrowed from the insurance company and then the investment like crashes. You have a safety backbone to fall back on. You still have the cash value in the whole life policy. You just have to pay back that loan that you borrowed, and then you can kind of split it up into as many payments as you want. And then you can even like miss some of the payments. So it's not like if you miss one payment, then like the policy is going to cancel. You can kind of control the payback period. But while you're paying that loan back over time, your cash value is uninterrupted. It's growing and compounding. And I think it's very important to also realize that like you never want to just trade your cash for risk. So because you don't know what's going to happen with that investment. And if you lose that investment and you lose the cash, then you don't have either or. You don't have cash now, and you don't have the investment. But with the whole life policy side, you still have the safety backbone. You still have the safety net to fall back on.
Okay, okay, awesome. And so, with like this sounds really good. What are some like there's like with everything there's pros and cons. What are sort of the cons to having one of these policies?
Yeah, the cons are, there is a capitalization period. There's a part where you actually have to capitalize the policy, you have to build it up. And for some people that might not be, favorable to them. They kind of want like faster money. So if you are, new to real estate and you're trying to jump in, this probably won't really help you that much. But however, if you're looking for like self-discipline and building the discipline within this policy, it's perfect. Because here's the thing, if you like, for example, when I first got my policy, I was putting in like $300 a month into the policy. It was almost like I was being forced to put in $300 a month. Like it was a payment, almost like an expense. But the cool thing is because every dollar I was putting in, a portion of that was going towards the cash value. It wasn't like a sunk cost. It wasn't like I'm just paying money into something I'm never going to touch. So it's kind of like a perfect balance, in my opinion, between locking up your money and it also being liquid at the same time. So at any time, if I want to access that cash value in the policy, I just print out a form or fill out a form requesting the funds, requesting a loan from the insurance company, and then send it in. And the liquidity is guaranteed. So it's not like I have to qualify for that loan from the insurance company. They'll give me up to 90% of my cash value. So it's a nice balance between locking up your money securely and earning interest on it, and also it being liquid too. It's so like you're almost forced to kind of put your money away somewhere. It's liquid, but not too liquid. Like if you have money in a savings account, you can access it nowadays in seconds just by going on your phone, your smartphone, opening up the app, and then you can just move money out of your savings account. And then what happens in that mindset is that it becomes really hard to save money, because that's why a lot of people nowadays, like I don't know how it is in Canada, but like 60% of the US like don't even have like $1,000 in a checking account, because they spend so much money. It's not the income problem, it's the saving problem. And I think the reason why people are spending so much money is because cash is so easy to access. You have a debit card, credit card, quick pay, Zelle, all these different tools and fintech tools, that you can just swipe and just spend money. So, and it's good for the banks and it's good for the financial institutions because they can charge fees on that money going back and forth and they can invest it quicker. But it's bad for the consumers because they have a hard time nowadays gripping their money. So I think it's a good solution for nowadays for people, especially for younger people, to actually be able to grip their money and like lock it up, but at the same time have it liquid when needed.
Yeah. I agree with you on that. Is making sure that to create those good habits is quite hard when you're able to just like transfer money from a savings account into your checking account, or go directly go to an ATM and pull out money out of your savings account. It's and then you sort of create that bad habit, and then it becomes like a norm, and it becomes much easier for you just to keep grabbing money out of it. So what is some advice for, let's say, somebody who's 18 or 20 years old, they're in university still or college, or they just started full-time employment. What would you say to them sort of for investing their money for the long term, and how to sort of protect themselves over the next 20 years, that when they do retire they have money that they can they're able to retire because they have money?
Yeah. I would say like first, like realize that there's only three things you could do with your money. You can either spend it, invest it, or save it. And with investing, it's at risk. It's not guaranteed that it's going to grow. And saving, you want to save for the future, but at the same time, you want to have your money being saved somewhere that in a financial vehicle that can kind of give you leverage and give you a push. So you're not just saving every dollar and it's not doing anything, because there's also inflation and opportunity cost. So I guess you want to like a nice balance between growing your money and saving at the same time. And if you're listening to this, you're 19, you're 20, check out the infinite banking concept. Go to YouTube, go to podcasts, check out, read the book, Becoming Your Own Banker by Nelson Nash, or Bank on Yourself Revolution by Pamela Yellen. Check out these books. Learn about this concept when you're young, because it'll help you out a lot, actually. And again, you don't need to be rich to do this at all. A lot of people, like a lot of my clients, like when I first started, and just like family and friends, when I was talking about this, they would say like, yeah, that's pretty cool if you're rich, it's pretty cool. But that's like saying, in my opinion, that's like saying you need to be fit to go to the gym. You go to the gym to become fit. And I think this is the same way. You learn these concepts to become wealthy. It's not like you need to be wealthy to use these concepts. So like, learn about this, and you can get started with just like a few $100s a month, and that'll be a big deal. Like, if you're putting a couple $100s in every month for 20 years, it's going to compound to hundreds of thousands of dollars in guaranteed income that you can have in retirement. And the cool thing, Max, is you're not locking up your money. Like you don't have to wait until you're 60 years old to touch that money. You could use that money while you're saving at the same time by borrowing against it. So it's almost like you become your own lender and your own saver. So you're putting money in, saving it, borrowing against it, paying your bills, paying whatever you want, putting the money back in, borrowing it again. And then you're relying only on yourself now. You're not relying on Wall Street. You're not relying on the government. You're not relying on large banks to take care of you. You're becoming self-sufficient and financially efficient, through using these methods.
Okay, awesome. And with that, is there any like tax savings that you can sort of like, is there like a tax-free account you can, because I know in Canada we have TFSAs, and I think over there it might be an IRA or like a Roth IRA or something. And then you also have we have RSPs, which are, registered retirement savings planning accounts or something. I think you guys, it's the 401k.
Yeah, exactly. Yeah.
So is there anything that you can do? So for, let's say for these, banking on yourself, is there anything that you can do when you're structuring it that you can, make sure, you're either deferring tax or you're actually, you've already paid tax, so it's tax-free, that your money actually making money on this?
Yeah, awesome point. There are tax advantages, very strong tax advantages, and I'm pretty sure they're very similar in Canada. But check with your tax professional, and if you're in the U.S., check with your tax professional. But the growth of the whole life policy grows tax deferred, meaning that if you have $100,000 in cash value in your policy, and the next year, because of interest and dividends, it's now $110,000. You don't have to claim that on your tax. You don't have to pay taxes on that growth in the gains. That's one tax advantage. The other is in most situations, you're using after-tax dollars to fund the policy. So you pay taxes on that, you pay taxes on that money, you put it into the policy, it grows now tax deferred. And then when you go to take that money out, you're taking it out tax-free because you've already paid taxes on it. So let's say you're in a 25% tax bracket, you work, you pay the taxes, you put the money into it. Now you've converted over to the 0% tax bracket. So if there's a spike in tax rates in the future, you've just created a hedge against that. Your gains in the policy grow tax deferred. When you access that money, it's tax free. And then of course and then hopefully much later on, when you're 80, 90 years old and you pass away, that death benefit, the life insurance part, is 100% income tax free under current tax law in the US, where it's federal income tax free. So your beneficiaries would get that money tax free.
Okay, awesome. And is there a certain amount that because I know for the tax free, for let's say for Canadian the tax TFSA, we have a certain amount, we have a limit, you can only put in 6,000. Right now the limit is $6,000 that you can put in a year. Is that sort of the same for, let's say, one of these policies?
Yeah. So with the whole life policies, in the sense of there are no federal guidelines for specific dollar amounts that are general to the public. Like for example, like a Roth IRA is $6,000 or $5,500, just like how you mentioned per year. With life insurance, it's the limits are more so based off of your income. So if you can only get up to 25 times your annual income in life insurance. So if you make $100,000 a year, the most you can get is $2.5 million in life insurance. And then from that, there are contribution limits that you could put in the eyes of the IRS, or the taxes, in other words. What that means is, for example, if you have a policy and you're putting in $10,000 a year, as mentioned, a portion of that goes towards the base life insurance, and the other portion goes towards the paid up additions rider, the cash value part of the policy. Now you have room to add a little bit more into the policy on top of that every year if you wanted to, like flexibility, but only up to a certain limit. You can't fund a policy for $10,000 a year and then add $20,000 on top of that, because then what will happen is the policy will become a modified endowment contract, or also known as a taxable vehicle. So you want to stay within limits. So if you were funding the policy with $10,000 a year, you'd probably be able to add, and the math is kind of hard to do, but you'd probably be able to add another $3,000 or $4,000 a year on top of that to have more growth, but at the same time to be within that tax-free guidelines. So to answer your question, there are some guidelines, but it's not like a federal limit, a dollar amount that applies to everybody. It applies on your income. It depends on the insurance company, and it depends on the funding. And then also, let's say you are hitting these limits, you can also get more than one policy, which a lot of people do. It's very common for somebody, to later on in the years to have 10 or 15 policies because they maxed out each policy,
Oh, okay. Wow. Okay. Yeah. So Yeah, that's pretty incredible. That's pretty awesome. So, so yeah, I want to sort of talk now about sort of like because you're a financial planner. What are some things that like you can start doing at a young age that you can sort of, good habits to create when you want to start saving money? Like like if you could go back to, let's say, when you were 18 years old, what would you have
Mhm.
done with your sort of money that you were making?
Yeah, I would pay myself first, no matter what. For every dollar you get, like think about it, you have $1 that comes in from, this hand, and then it goes out the other hand. You want to figure out a way to grip it in between, and the only way you could do that is by paying yourself first before you pay anybody else. And it sounds kind of selfish, but it'll actually help you out long run, and it'll actually help, whoever you're supporting, it will help you out in the long run. Because what's going to happen is, if you, for every dollar you earn, you take a piece out of that and you put it somewhere where you could pay yourself first. And this is the concept called profit first too. I didn't invent this. You check out the concept profit first, and it's pretty much paying yourself first. So you would earn, for every dollar you earn, you would take a cut out of that to pay yourself first, and then pay your expenses and everything else you have. So when you have that mindset, you pretty much, you figure out how to pretty much make money and save money even when your income is pretty low. You know what I mean? If that makes sense.
Oh, okay. Yeah, yeah. I've heard about that before, and yeah, it's that's a very good concept and a really good habit to start. When you pay
Yeah.
yourself first, I agree with you on that. Is like, yeah, making sure that either you take 10% or 15% or 20% of what
Mm-hmm.
you make, and you put that aside right away, so it instantly, because like either way, like the majority of people, it's like I'm guilty of it. If you just have money sitting in your account, it's easy to go, to go buy food or go buy something with it, because you're just like, okay, yeah, let's, like, your friend's like, hey, do you want to go out to like a game or something, or do you want to go do something, and you can go spend that money, and it's just sitting there, instead of like, dedicating, it sort of sets that limit, right? It sets that limit for
Yeah.
what you can sort of do and what you can't do. And it's like, no, you're consistently saving towards something and investing your money. So yeah,
Yeah.
I know we're coming to the end here. It's been great having you on the show. Where can people actually find out more about you and sort of like what you do, and sort of what your company's about a little bit more?
Yes, you can go to finassetprotection.com. It's FIN, assetprotection.com. In there, you can book a free consultation. All our consultations are virtual and free. You can book an appointment there. You can check out some of our other podcasts, videos. Yeah, you can email me. You can give me a call. Yeah, and I look forward to hearing from you guys. And also, Max, as a special for the listeners, if they reach out and they say they came from your show, I will send them a free copy of the Bank on Yourself Revolution book. That's the book that talks about everything we've been mentioning. I'll send it to them via Kindle for free. It's like $15 on Amazon, but if they reach out and they book a free consultation and they say they came from your show, I'll send them a free copy of that book.
Okay. Okay. Awesome. Well, thank you for coming on the show, Sarry. And yeah, guys, if you've made it to the end of the show here, thank you for listening all the way through. Yeah, go check out, Sarry's company and what he's doing, and the Bank on Yourself loan, the Bank on Yourself policies. And yeah, if you can go over to Apple, leave a review, subscribe, and sort of tell people a little bit about what you thought about the show. Anyway, it was great having you on the show, man.
Thanks, Max. Thanks for having me on. I appreciate it.
Awesome.